when we get to the fourth turning, all hell breaks loose from the perspective of internal politics, geopolitics, and all that hell breaking loose has important implications for the economy and asset markets. We just think that there's a tremendous amount of upside risk associated with investors kind of coming our way to where we are with regards to the business cycle. If you look at the last 50 years of the quintiles of income, only the top quintile has actually gained income on a relative basis. Even in the fourth quintile, we've seen persistent decline. If you kind of take the administration's full kind of gamut of policy changes from fiscal, regulatory, and trade policy on the trade policy front, the net impact of that should create a durable positive shock to growth. The problem is consensus is myopically focused on one of those particular, tools, which was tariffs.
Darius, welcome back to Excess Returns. It's great to have you on, man.
It's so great to be here, man. How you guys doing? Justin, Jack, it's been a while.
Great. Yeah. We're excited for this conversation. There's a lot to cover today. We're going to talk about regime shifts in the market, important trends that you're paying attention to, inflation, tariffs, the impact of AI on life in general, and just kind of where we are, in this cycle. Because we know you have a lot of thoughts on the macro environment and landscape, and you're going to be sharing some slides with us today. So for those that are on the audio feed, YouTube might be a little bit more effective for you. So pop over there. And for those that don't know Darius or aren't familiar with his work, he offers macro insights and systematic frameworks and actionable investment strategies through 42 Macro. You can find out more on 42macro.com. And he's also very active on X, where he shares sort of insights and commentary pretty actively. So yeah, we're looking forward to, having another good conversation with you, Darius. So thank you.
Oh, it's great to be here, man. I didn't know we were calling it X.
It's actually funny. We just got a comment on a video the other day. We put out with Liz Ann Saunders today. Like, one of the comments was like, "What is this X you're talking about?
No,
we've never heard of this." So I had to respond. Oh, that's Twitter. That's what Twitter. Yeah.
Well, I guess
some people don't know.
Right. Yeah.
Well, let's hop into it. I know we're better for this.
Yeah. So we had Neil Howe on the podcast recently, and I know that you talk and reference the foreign framework, often. So I thought it would be interesting to start out with, how does that idea sort of influence how you're viewing the markets today?
Yeah, I appreciate you bringing that up. Neil is a good friend and one of my mentors, someone I worked with for a long time. Just tremendous amount of respect for him. I hold him in the highest of regards. One of the two smartest people that I've come across in my lifetime. And I would say I've come across quite a few intelligent people. So big fan of Neil, big fan of his work. Obviously big believer in the fourth turning, the generational framework that, just kind of the 30-second version is, when we get to the fourth turning, all hell breaks loose from the perspective of internal politics, geopolitics, and all that hell breaking loose has important implications for the economy and asset markets, vis-a-vis the big changes that we tend to see from a fiscal and monetary policy perspective. That's all that economic and financial market work that we've attached to the fourth turning framework. That's work that we've done here at 42 Macro to build on Neil's work in terms of explaining the framework. That's sort of the realm Neil has lived in and is helping investors around the world and very large, S&P 500 type companies, guide them through this transition. But I think, one of the things we did for our clients here at 42 Macro is, say, if we believe in the fourth turning, which I obviously do, how do we create insights, create a roadmap, if you will, for investors to sort of navigate that? So we did a big deep dive empirical study a couple of years ago to essentially, help investors understand, what should you be expecting from the perspective as an investor in a fourth turning regime. So we broke it down through sort of four different buckets. So I'll start with fiscal policy. In a fourth turning, what tends to happen in fiscal policy is that you tend to see explosive growth in sovereign deficits, the debt, the size of the government, and the cost to finance the government. With respect to monetary policy, as a function of all that fiscal dominance, you tend to see dramatic financial repression and accelerated monetary debasement to sort of offset that and alleviate the burden on society of all that fiscal policy. It really is to alleviate the burden on financial markets. Our thoughts on that, which is becoming headline news now. And then from an economic standpoint, you tend to have faster than normal nominal GDP growth, faster than normal inflation, faster than normal wage growth. This tends to be a very populist regime. It's all about redistribution and trying to break down the legacy institutions, both within and across our borders, that are contributing to all the inequality. And so part of that process, ultimately, ironically, you tend to see more a faster asset price inflation as a function of the solutions that the government is trying to put in place to break down that inequality. And ironically, it kind of makes the whole process worse. And this is why, if you think about the final kind of pillar before turning, which is the geopolitics of it all, is you tend to wind up in a pretty nasty place from a geopolitical standpoint. You tend to eventually get to the structural downtrend and income inequality as a function of the redistributive policy. But along the way, you tend to see declining birth rates, increased trade protectionism, and ultimately, every foreturning since the 1400s has ended in total war. Hoping we can avoid the total war part with guys like Neil and myself making this framework available and to investors, and not just investors. Corporate clients, insurance fund clients. I'm sure we're pretty plugged into the administration. The current Treasury Secretary is a former longtime client of mine. So hopefully, this type of information is feeding up the food chain, if you will. We could try to make some thoughtful decisions, both as investors, but also as a society, to kind of avoid the worst of it all and kind of get us landed safely into the first turning.
Yeah, and this isn't like the end of the world type podcast, and there will be some positives that we're going to talk about here, but just in terms of like talking about the timing of like some of the things that you said with levels of debt and the other aspects of the fourth turning, we're sort of living through that. Like, it seems like it, at least. But, what, in terms of like timing of something like this, like it doesn't just obviously happen in like one quarter or 1 month or something like that. But do you have any sense of that, at least historically, when economies and societies have entered these fourth turning periods, like what the duration of it is? Roughly?
Yeah, I'll defer to Neil on specifics, but traditionally these tend to be 20 to 25 year cycles. And so if you believe, like Neil and I believe, that the fourth turning started, it was catalyzed with the global financial crisis back in 2008, that would seem to suggest we probably have another at most 5 to 10 years left. I can make the case, Neil has made the case that this fourth turning is likely to be a little bit longer than normal. I'm hoping that it isn't. As someone who brought a child into the world and celebrated my son's first birthday yesterday, I'm hoping that we can get out of the soup as quickly as possible with the minimal, I guess, crisis type events as possible. But that's wishful thinking. It potentially could be. And so my job as a macro risk manager is to help our clients safeguard their portfolios, whether they be an institutional investor or a retail investor. My job is to help them safeguard their portfolios for the left tail risk, so they can take advantage of what we continue to see as substantial right tail risk as a function of the monetary solutions that you tend to see in a fourth turning as a result of fiscal dominance.
Let's kind of pivot a little bit more towards some of the stuff you're doing at 42 Macro, like in the now. Can you explain how your macro regime nowcasting sort of system works?
Yeah, absolutely. So that's a great question. I love nerding out on this stuff. So I think let me take a quick diatribe. We spend a lot of time on podcasts like these, or at least I do, talking about fundamental dynamics in the economy. Where are we headed with growth? Where are we headed with inflation? Where's monetary policy headed? Where's fiscal policy headed? What are the current liquidity dynamics? How those will likely evolve in the future? And then ultimately, how's positioning relative to all those things, and what's priced in and what's not priced in. That is what I spend most of my time outside of our paywall talking about. What I spend most of my time inside of our paywall, at least where our clients derive the most value from our research, is on our systematic risk management overlays. So my former life, I worked on Wall Street to help design and develop, risk management systems for our buy-side clients. Essentially was a consultant, risk management consultant for buy-side investors. And, when we started 42 Macro, I started it with a kind of the hope that I think there's a way to create risk management frameworks that ordinary investors can tap into, so that they themselves can benefit from what I think is high quality hedge fund level risk management of their portfolios, so that, Wall Street aren't the only people, I guess, benefiting from these types of insights and signals. And so one of the tools we built for our clients to help kind of, achieve that objective is our global macro risk matrix. It's our market regime nowcasting system that essentially helps tell our clients, okay, are we risk on? Or are we risk off? If you're a buy side investor, you need to know if we're risk on with the disinflationary bias or risk off with risk on with the inflationary bias, or risk off with the disinflationary bias or risk off with an inflationary bias. That incremental, nuance is relevant for institutional investors. But primarily, if you're a retail investor listening to me talk right now, what you generally need to know from a risk management standpoint is this: our market's risk on and risk off. And so we built this system, which is much better than using, in our opinion, a back test much better than using technical analysis or tools that retail investors have traditionally used. And so how the system works is we're scoring 42 of the most important institutional markets in the world through the lens of what we call our volatility adjusted momentum signal. You can sort of get a sense of what that looks like, just kind of looking at like maybe a chart of the S&P 500, green being bullish. That means volatility is confirming the momentum of the asset class. Neutral being volatility is not confirming or disconfirming the momentum of the asset class. It's disconfirming the momentum of the asset class. And then bearish would be the momentum is negative, and volatility, the volatility of the asset class is actually confirming that. And so what we found is that historically, volatility tends to changes in volatility tend to front run changes in momentum. And so right there, just that institutional knowledge right there can allow you to be one step ahead of the crowd as it relates to trying to understand big swings and inflections in the momentum of broad asset markets. And so we're doing that. We're running that volatility adjusted momentum signal process across 42 of the markets, most important markets in the world. These are all stocks, volatility instruments, commodities, foreign currency or FX, and then fixed income, rates, spreads, OIS, all that good stuff in the rates market. And so we're tallying up each of those volatility adjusted momentum signals on a daily basis to identify which markets are confirming which of the regimes. So, for example, the S&P 500, which is bullish and has been for quite a while, is giving a point to both Goldilocks and reflation. The S&P in isolation has no idea if we're in Goldilocks or reflation, but based on its current volatility adjusted momentum signal, it knows that we are, in one of those two regimes. If I knock on the door and ask, let's say I'm just picking random securities here. Let me pick the 30-year Treasury yield, nominal Treasury yield. Right now, that's bullish from the perspective of its own volatility adjusted momentum signal. It doesn't know if we're in reflation or inflation, but it knows based on how the 30-year Treasury yield has historically traded across those four regimes, it's in one of the two. And so every day we're summing up the cumulative amount of signal in that's being garnered by each regime. And then whatever regime has the highest sum and share of confirming markets in this table, we in that model, we determine if the market regime. So all the rest of our sort of investment recommendations, factor recommendations, asset allocation recommendations, all that comes from our identification of the regime. And so right now, if you look at Dr. Mo, which is the tool we built for institutional investors to push our market regime nowcasting signals to their portfolios, right now, Dr. Mo realizes that we're in Goldilocks. So all the proper trade logic is based on Goldilocks. And so right now, the S&P is bullish. And so the S&P's own volatility adjusted momentum signal condition is bullish, and we're in a market regime where the S&P should be bullish. So Dr. Mo is generating a long max position for the S&P. Right now, if you look at energy, it's only neutral from the perspective of its own volatility adjusted momentum signal. And so it should be bullish. So Dr. Mo is saying, well, there's something wrong here. You can be a long half position. For example, the 25-year Treasury bond is bearish, and it should be bearish in a Goldilocks regime. And so right now, Dr. Mo is currently generating a short max position for treasuries. And then I don't think there's anything that's short half position now, but if there were something that should be negative and had a neutral signal, then Dr. Mo would be generating a short half position. So this is a risk management overlay to tell investors, particularly institutional investors, but we have some very sophisticated retail trader clients who want to have this kind of type of overlay applied to their portfolio. It tells them exactly what the market and other institutional investors think about their asset class with enough information and specificity to essentially guide them from a market timing and position sizing perspective. You don't ever want to be too far. You don't want to ever have your portfolio leaning too far away from what our market regime nowcasting and our Dr. Mo signals are suggesting, because it means you're going to be on the wrong side of market risk for an extended period of time. And that's where the big left tail events in your portfolio. And that's how you wind up, wearing stuff like this on the beach as a former buy side PM.
Well, and what I love about this is this isn't like Darius telling you like what asset classes to be in or Adam. This is a systematic approach that's obviously disciplined, free of emotion. It's repeatable. all the good things you want in sort of a strategy, rather than, you wake up one day, you read the Wall Street Journal, it looks like the world's going to hell. And you're completely wrong with how you're trying to position your portfolio based on that. So I think that's, we're big believers in systematic approaches like this. And this is why we'd like to have you on to talk about the way that you approach macro investing.
Yeah, can I say one quick thing on that? Because I completely 100% agree with you. I'm not smart enough to tell thousands of investors around the world, or thousands of institutional investors, what they should be doing in their portfolios. Simply, they're all smart enough to do that on their own. What I'm smart enough to do is build systems that put guardrails on and eliminates the big mistakes that investors tend to mistake, largely as a function of common behavioristics that we all tend to share as investors that cost us to, make just poor investment decisions. And the reason this process works is because we know from studying similar works from folks like Benoit Mandelbrot or Cass Sunstein or Emil Spursky and Danny Kahneman, that volatility clusters, which you do enough math, you realize that price tends to cluster. And so looking at this, or just using the S&P 500 as an example, 91% of the cumulative performance in the S&P 500 since the start of our rolling out of sample back test, which is January of 1998, 91% of that performance has come when our Dr. Mo signal has generated a long max position. 40% of that performance has come, more than the 100 cumulative 100% has come. Another 40% has come when Dr. Mo generates a long half position. So 131% of the return that you would have generated from being naked long the S&P since January 1998 has come when Dr. Mo is telling you to be long the S&P, which obviously means that if you're not there, if you avoid being long the S&P when Dr. Mo tells you not to be long the S&P, you eliminate the left tail risks from your portfolio. Now imagine doing that across all of these different factors, across multiple market cycles, and what you're essentially doing as an investor is creating a positively skewed return distribution just by respecting the evolution of the market regime, and secondarily, the evolution of the volatility, just the momentum condition of each asset that you're trading.
By the way, I might have been today years old when I figured out where 42 macro came from, because I thought it was your football number, but you also mentioned you cover 42 markets. So I'm wondering if maybe it's both or something.
No, well, the real genesis is an ode to Jackie Robinson, who's one of my heroes. Honestly, he changed my life in terms of setting me down this path and wanting to create something for, I would say, everybody. I spent the first 12 years of my career just making rich people richer. And I saw that quote by Jackie Robinson, a life is not important except for the impact that it has on other lives. And I realized that, hey, I'm someone who got out of the hood, grew up in a terrible childhood, and parents were drug addicts, and, spent many nights in homeless shelters and sleeping in vans and living in motels. And I realized, like, hey, I wasn't pulling anybody up with me. And so I just got, I got the itch to go help people and try to give back. And so 42 macro is one of the many manifestations of my life where I'm actually trying to give back and create a positive outcome for society.
And that's so cool, because this type of stuff was not available to your average person. I mean, you're really pioneering a lot of that in terms of making this at a cost point where your average person can actually, afford it.
I want to change the world, Jack. I don't see why not. There are tons of people who change the world. Why not Darius Dale? Why not Jack? Why not Justin?
That's so cool. Yeah. No, it's a great attitude to have. I mean, I should have it more myself, to be honest.
Yeah. 100%.
So shifting back to your process, one of the things I like to look at with systematic processes is whenever they make a change, I think you can understand a lot about how it works. Mm-hmm. So, and I know you went earlier in the year, I think it was like in March, you were pretty bearish and you shifted to much more bullish in April. So I was wondering if you could maybe talk about behind the scenes, what happened is like an illustration of how the system works.
Yeah, 100%. I can just illustrate that on the chart. So this right here, the breaking out into a risk on market regime where I want to say it was either deflation or inflation became the modal regime in our nowcasting framework, market regime nowcasting framework, I want to say on March 3rd or March 5th. And so that took that changed the proper trade logic for Dr. Mo, so that the logic behind how you want to be disposed to each of these factors changes. So for example, if we went into a risk off market regime, let's use inflation as an example, and the S&P broke down to neutral from the perspective of volatility, just a momentum signal, instead of going from long max position to long half position, Dr. Mo would know that we're in inflation and say, actually go to short half position, right? So that there's a logic behind how the model works. And so we push those signals to retail investors through the lens of our KISS portfolio construction process. That's a much more simpler solution with just 3 ETFs, stocks, gold, Bitcoin. It's the same logic, but you're kind of doing it from an asset allocation perspective, using just stocks, gold, and Bitcoin. And so in terms of how that worked, we helped our clients get to the sideline in terms of raising cash so that they can, generate some dry powder in their portfolio that they can actually buy the dip with. And our process started to have them buy the dip back in on April 14th with Bitcoin and April 30th with regards to the equity market. And then by May 15th, we had broken into a risk on market regime. And so once we were in a risk on market regime, obviously, Dr. Mo and KISS, which is the retail solution, those got obviously incrementally invested, and we've been largely fully invested since then, participating in the upside. So, it's the same exact system that'll help us, get to the sidelines and raise cash, early into a bear market. Same exact system, same exact process, no change, no Darius Dale input. Same exact system says, okay, the crash is over. Now it's time to start to redeploy that capital and take advantage of the right tail risk that is brewing asset markets. And so, super proud of what we built. Obviously it's highly effective. We have thousands of clients all around the world. I think we have some of the best testimonials in the world. And part of the reason for that is, the hurdle wasn't very high. The stuff that Wall Street was selling retail investors was, quite frankly, not very good. This is the kind of stuff that institutional investors sell to their clients for 2 and 20 and 3 and 30. And I'm insisting that those are outrageous prices. And I want to, change the world in terms of how retail investors are investing in as opposed to asset markets. And so we're happy to sell it at our price point.
We see something that we haven't seen in a long time or haven't seen in our careers, like tariffs. Does it impact the systematic process like yours, or is it more the variables you're looking at, really tariffs will flow into those variables, so you don't really have to worry about adjusting anything because tariffs exist?
Oh, that's a great question. Love that question. And the reason why I love the question, because the answer is no. Nothing impacts this process that from a fundamental standpoint. This is a purely systematic quantitative process. If tariffs matter, then they're going to matter to one or more of these 42 markets through the lens of our volatility, just a momentum signal condition. Like if something bearish happens and it actually is going to be a big enough negative shock to the growth cycle, or the positive shock to the inflation cycle, or a result in a fiscal or monetary contraction, or a reduction in global liquidity, all those things will get picked up by asset markets. What we're essentially doing is knocking on the door of the 42 most important markets in the world. It's like, hey, S&P, what do you think? Hey, MSCI Emerging Market Index, what do you think? How about you, Nikkei? How about you, NASDAQ? How about you? And so on and so forth, all the way to the 2's10 curve over here. We're doing that every day. And so there's a lot of information in remaining at the vanguard of, markets. There's not a ton of information in just looking at a chart and be like, oh, the chart's been trending higher for a long time. There's a ton of information in noticing when things change, because that's what allows you to buy things before other people in the marketplace are going to be forced to buy or cover, or sell things in the market that other people are going to be forced to sell or short. And so that's exactly what institutional risk management is. It's not about, I think therefore, in terms of, generating investment ideas. I could care less about anybody's investment ideas or even my own. What I care about is putting my buy or sell order ahead of other people's buy and sell order. That's how you stay on the right side of market risk and compound returns from an institutional risk management standpoint. So, like I said, I'm super proud of what we built for the retail audience, but obviously we have institutional clients all over the world. Our clients collectively manage over $25 trillion. So, you can imagine who we're talking to.
I want to look forward and ask you about economic growth, but first I want to look back and ask you about recession signals, because, and you didn't do this, but one of the things you've seen for a long time now is many economists saying the recession's here, the yield curve's inverted, the Somme rule triggered, whatever it is. And it seems like a lot of those signals maybe haven't worked very well in this environment. I'm wondering if you have any feelings as to why that is.
Another great question, man. You guys are good, man. I can nerd out with you guys.
We try our best.
So I studied at Yale, and I'll be the first person to tell you, like, I am not a fan of this economic gobbledygook. There's so much gobbledygook on top of gobbledygook. And when it comes to the social science that is economics, I just don't understand. I do understand it. I just don't believe in it. I think there's a lot of theory involved. And the reality is when you try to manage financial market risk with theory, you're going to eventually go wrong, because the economy and asset markets are always changing, right? And so what we do here at 42 Macro is we base all of the decisions that we make from an institutional risk management standpoint as it relates to interacting with asset markets, but also all the decisions we make as it relates to communicating to our clients what is likely to happen in those 6 cycles that I mentioned earlier. Those are the only cycles that really matter to asset markets: growth, inflation, monetary policy, fiscal policy, liquidity, and positioning. When we communicate to our clients where we are in those cycles, it's not based on any theory. I can go grab 1,000,000 old textbooks and tell you that there's a theory that says X or Y, but the reality is that's just not how the world works. And so what we do at 42 Macro is we boil everything down to the raw empirics. What are the statistics? What does the data actually say, both now and historically? And so part of the reason I think investors kind of miss the recession call, and we haven't, we authored, not to take a victory lap, but I think it's well deserved. We authored the resilient U.S. economy theme that you keep hearing talking head after talking head, going Bloomberg and CNBC for the past 3 years. We authored that theme in the summer of 2022 when everyone thought we were going into recession, and we've been pounding the table on that theme since then. And obviously, it's made its way across global Wall Street, if only through our clients who are showing up on TV. And so, part of the reason we authored that theme was we understood that, hey, the processes, the cycles within the business cycle are not evolving in a way that would suggest there's a high probability of a developing recession on the medium-term time horizon. And so how do we determine that? So one of the big things we did is we created this business cycle model that looked at hundreds of time series to identify, okay, where we, what actually leads and lags in the business cycle. I think one of the things that I think you guys would agree with is, particularly in the retail focused investment, advisory space, there's a lot of chart crimes. There's like a 5-year chart of this and a 14.5 day or week lag with this chart. And then there's like, okay, this is leading and this is breaking out. Like, that's not analysis, by the way. If for anybody paying attention, you certainly will get laughed out of a room on global Wall Street with that stuff. What we try to do is, okay, what is actual, durable, persistent, leading or lagging indicator to the business cycle across as many market cycles as we can go back and find the data for. And so that's essentially what the output of this model is. So what I'm showing here in the left chart, it's the median, you can read, let me just summarize it. It's each one of these lines represents the median path that particular cycle takes before and after recession. So this is 3 years ahead of a recession. This is 3 years after recession begins, with 0 being the start of a recession. And so what we've learned from that process is, okay, we studied the post-war business cycles of the U.S. economy. What we find is that policy is the longest leading indicator. So monetary policy tends to get restrictive, let's call it 15 months ahead of a recession. Then we get corporate profits. They tend to break down, let's call it 9 to 12 months ahead of a recession. Liquidity starts to break down 3 quarters ahead of a recession. Growth and stocks tend to break down 2 quarters ahead of a recession. The unemployment rate breaks out right when the session starts. That makes sense. That's when the NBER, these, baggy suit wearing economists, that's when they notice. And then no offense to anybody wearing baggy suits. Uncle Warren wears baggy suits, and I'm a huge fan of his. Credit tends to break down in terms of delinquencies and charge-offs breaking out. Let's call it a quarter after recession starts. And then inflation starts to break down durably below trend 12 months, or about a year after recession starts. And so if you want to predict a recession, in theory, you should be at the bare minimum seeing some, correlation in today's data from a cyclical, from a pattern standpoint that sort of matches what it looks like when you're heading into recession. And so for quite a while, we've had policy, quote unquote, restrictive from the perspective of how we're scoring it in this model, but we didn't necessarily see that cascading breakdown in corporate profits. We saw a little bit of a dip in liquidity and growth, but we didn't necessarily see that breakdown in profits, which in my opinion, I think is really important as it relates to, connecting all these cycles to the employment cycle. And so in my opinion, it's been very helpful for us to sort of stiff arm at various intervals using this model and other high frequency indicators to say, hey, we're just not seeing the kind of stuff you tend to see before a recession, right? I'm terrible at analogies, but if you want to hit a grand slam in baseball, there needs to be 3 people on the bases, right? Somebody's got to be on first base, someone's got to be on second base, and someone's got to be on third base. You can't hit a grand slam if there's nobody on base. And so, and that's sort of the kind of approach we took to kind of triangulating where we are in the business cycle. This process is, I don't want to purport to suggest that any process or any model or any framework that we are able to develop here at 42 Macro is perfect and doesn't have error. What I am purporting is that we understand where our error is, and we supplement our research with a robust enough set of indicators so that we're not overly reliant on one model's particular error. We can mitigate the amount of error we have from a covariance perspective by, applying a bunch of different frameworks and a bunch of different indicators.
Just as a PSA on your point about chart crimes, I think we would all be better off if before we retweeted the chart, we actually took some time to understand what's in the chart.
100%.
Because you see that so much. These charts go crazy. They're just completely nonsensical.
Nonsensical. I mean, look, if your goal is to trigger someone into subscribing to a research business, by all means, create chart crimes. I'm not here to get at anybody's livelihood. My point is, if your goal is to help people remain on the right side of market risk, I don't think chart crimes are a particularly useful tool for that.
So you talked about how the recession, it doesn't look like we're on the verge of recession. You correct me if I'm wrong about that, but how are you thinking about growth? I know that's one of the biggest components to what you're doing. Like, how are you thinking about growth and where we are right now?
Yeah, 100%. So if you look at where consensus is, so we are, the headline is we're continuing to pound the table on our resilient U.S. economy theme. So I have a tremendous amount of conviction in that. This is year 3 now of us pounding the table on that. So we are of the view and have been of the view the whole time that, hey, the economy has very limited risk of developing recession. We just don't see it in the data. We don't see it in the patterns of the cycles. But what we see is a tremendous amount of upside risk in asset markets as a function of Wall Street, coming to agree with us. And obviously a lot of that has taken place in the last 3 months since we pivoted to our Paradigm C theme. And so that's kind of what Paradigm C is recognizing that, hey, if you kind of take the administration's full kind of gamut of policy changes from fiscal, regulatory, and trade policy on the trade policy front, the net impact of that should create a durable positive shock to growth. The problem is consensus is myopically focused on one of those particular, tools, which was tariffs and the trade policy. And so the reality is, I think there's an overestimation of the non-resiliency of the U.S. economy currently going on. That's still, we can see it in market pricing. We can certainly see it in survey data. This black line in this chart here shows the Wall Street consensus 1 year forward implied recession probability. So Bloomberg, they survey, over 100, Wall Street economists and strategists every time they, create a time series like this. And the median Wall Street, strategist, economist, whoever they're surveying, thinks that there's a 35% chance of the U.S. economy going into recession over 12 months. We at 42 Macro and sit even on the lows of April, 8th or 4th or whatever the market low was, we thought that was a 0% probability or somewhere near 0. And so it's our belief that, this number needs to go down. It could get cut in half easily to get to where like a normal type level is. It was at 20% heading into the year. It's got to get at least back to 20% before I think consensus is even anywhere close to us in terms of, our estimation of the durability of the economy. And so, in terms of how we're thinking about growth, we just think that there's a tremendous amount of upside risk associated with investors kind of coming our way to where we are with regards to the business cycle. One of the models that we run for our clients daily is our grid model. And what we're trying to do is sort of create a high probability path forward for growth and inflation. We don't anchor on these forecasts, find very much use in investing based on forecasts. We invest based on, what the market is telling us to buy and sell before other people are. But if you want to anchor on these forecasts, our model is suggesting that growth is likely to surprise to the upside over the medium term, as far, in terms of our rolling next 12-month time horizon. And so assuming that is correct, what is likely to cause that to be true? Well, one, we have fiscal stimulus in terms of that we're likely to see peak positive fiscal impulse over the next, let's call it 2 years. If you think about the one big ugly bill that was just signed into law, we also have what is likely to be the advent of perhaps asymmetrically dovish monetary policy. We can talk about that in terms of what we continue to see is we've been saying that the Treasury is eventually going to LBO the Fed in this fourth turning and use the Fed, much like it did in the last fourth turning, as a tool for helping capitalize the U.S. Treasury market, a growing geopolitically driven supply and demand imbalance in that market. So that's coming. It may not come on a short to medium term time horizon, but we know that the direction of monetary policy is dovish, not hawkish. So that's supportive at the margins. We continue to see tremendous amount of strength with regards to private sector balance sheets. The household sector balance sheet has never been this strong ever across a variety of metrics, like several important indicators. The corporate balance sheet is about as strong as it tends to get. So you're talking about incredibly resilient balance sheets that are being doused with fiscal stimulus, that are being doused with monetary stimulus coming down the pike. That's just, it's hard to fight that as an investor, as a bear, in our view. So ultimately, we think the probability that growth generally and persistently surprises to the upside is high. And oh, by the way, that is also the highest probability outcome based on this statistical process here. So you're kind of winning in both regards. Remember I said, we supplement our views with a variety of different frameworks and models. And, we're kind of arriving at the same conclusion, whether we look at our fundamental process that's, okay, connect the dots on fiscal and monetary policy, or our quantitative process, which is what is the highest probability path for growth and inflation, as looking at this model here on slide 80. Both of those things are telling me that growth is likely to durably and persistently surprise to the upside over an investable time horizon, like, inside of a year. So in my opinion, that needs to be priced in.
Can you talk about the paradigms a little bit more? Because I think that tells us a lot about where we are and maybe where we're headed. So can you talk about what they are and what they mean?
Yeah, 100%, 100%. One of my favorite images I've ever seen in my lifetime was this. Not because I'm a Republican. I'm not a Republican. I'm not a Democrat. I'm a data-driven centrist. I wear a purple tie. It's a little bit too hot. Just got back from working out, so I couldn't put a tie on. So I apologize for my beach wear. Otherwise, we sweating profusely.
Nicer than my t-shirt.
Yeah, exactly. No worries. But no, and the reason this is one of my favorite images is because it confirmed a lot of what I already thought from a fourth turning perspective. This tells me that people are pissed off. It gets, again, this is not a Republican statement. It's not a Republican talking. It's not a Democrat talking. This is someone who recognized that, man, from sea to shining sea, people are pissed the hell off. Pissed off. Okay, so why are they pissed off? Okay, well, let's go back and do the work. There's rampant income and wealth inequality. I'll throw a stat at you. If you look at the last 50 years of the quintiles of income, only the top quintile has actually gained income on a relative basis. Even in the fourth quintile, we've seen persistent decline. So unless you're at the very top of the K-shaped U.S. economy, you're actually losing on a relative basis to the people at the top part of the K. And this has been going on for almost 50 years. That's also represented in wealth inequality. If you look at the top median, U.S. households own 97% of financial assets and 94% of all assets, whereas obviously the bottom median is 3% and 6% respectively. So clearly there's a dramatic K-shaped divide in the economy from the perspective of income and wealth inequality. So that's one reason why from sea to shining sea, the electoral college map might look like this, which is absurd, right? Like we may never see. We're probably going to see it again, but it's probably going to be blue at some point if these policies don't work out as relates to deepening the fourth turning poly crisis. But that's probably 4 to 8 years in the future. We don't have to worry about that today. We also had a 40-year high in inflation. We had fiscal largesse and monetary largesse. Essentially let the inflation genie out of the bottle. And obviously they've done a very poor job of putting it back into the bottle. It's been over 4 years now. Core PCE is surprised to the Fed's it's not even their inflation target. It's actually easier to win on core PCE, and they still haven't won in over 4 years now in terms of getting core PCE to and through their 2% inflation target. So people obviously don't like 40-year highs in inflation and the cost of living crisis that has created for all the households on the bottom part of the K, and I would say increasingly some of the households on the middle part of the K as well. And then we had this historic crowding out of medians, low to median income household and small to medium sized enterprises. If you look at the U.S. government, I want to say we were absorbing about 40% of all. If you look at the next 12-month marketable borrowing that the U.S. government does, and so how we triangulate that's the debt maturing in the next year. We annualize the fiscal year to date budget deficit, and then we annualize the rate of divestment from the Fed's Treasury portfolio. If you wanted to look at that statistic, we were eating about 40% of household savings and corporate profits. That number tends to trend somewhere close to like 20%. It was more than a double in terms of the amount of capitalization that was required to satisfy the U.S. Treasury relative to what it tends to trend at. And so obviously there just wasn't enough cash going around from a credit standpoint to get to small to medium sized enterprises and low to medium income consumers. And part of the reason why they've been left behind from a GDP perspective, that GDP is not flowing to them because they're not really participating in the economy to the same degree. So those three factors contributed to, again, what is one of the most profound images I've ever seen in my lifetime. And so as a function of that, this was us exiting that was America saying we're sick with paradigm A. Paradigm A was what caused this. It's the inequality, the inflation, and the crowding out. This gave us, when we saw this map last fall, it was a signal to us that, hey, the administration has a very clear mandate here to come in and try to fix this. And the most effective way to fix this, particularly from the perspective of the fourth turning poly crisis, is to try to cut your way out of this. Shrink the size of the government, put the monetary largesse away, and ultimately you have a much less inflationary economy, much less crowding out in the economy, and ultimately you're setting the economy up. You're going to have to take some pain to do that, but you're setting the economy up to have, growth being driven by, productivity and innovation as opposed to, depreciation of financial and real assets. And so that's what we thought would happen. And that's why we came into the year anticipating a crash in asset markets and risk assets, because we thought, hey, the Trump administration is going to pivot us to paradigm B. We saw them try to pivot us to paradigm B, and that essentially ended on April 9th. And the reason that ended on April 9th, and I'll walk you through this journey and why we have so much conviction in bullish paradigm C as opposed to going back to bearish paradigm B, is because of what happened on April 9th. If you guys remember, in the wee hours of the morning at like midnight on April 9th, we saw a complete meltdown in the treasury market. They were selling in the S&P futures. They were selling in the dollar. It was like, oh my God, there is a real true capital outflow from the United States of America that we traditionally have never seen. And part of the reason for that is, okay, well, if you try to unilaterally rebalance global trade with a $26 trillion net international investment deficit, you might have some problems from a capital outflow perspective. And that's exactly what we saw. I mean, that's 90% of our GDP, a fourth of global GDP from the set of our net international investment deficit. So the capital outflow situation that we saw in early April and early to mid-April from a sell America trade perspective, in our opinion, was a real risk to the U.S. economy, because ultimately what it meant is we were no longer going to be able to capitalize our record non-war, non-recession budget deficit of 6 to 7% of GDP. We would struggle to capitalize our, not quite record, but near record current account deficit of 4.6% of GDP. You put those two statistics together, we have a twin deficit of almost 12%. That's like on par with a country like Brazil or Argentina or Turkey, yet we're capitalizing our twin deficit at 4% when you take the mean of our 10-year and our earnings yield. So like, our general level of our general cost of capital in our economy is on par with Japan, which is one of the world's top 3 net international investment surplus economies. And we're capitalizing ourselves below Europe and China, which are number 2 and number 3 from a net international investment surplus standpoint. So the key takeaway from all this is why we have so much confidence that we're not going back to paradigm B is because if we would allow that situation to persist, let's say President Trump put earmuffs and blinders on and said, nope. We're going to unilaterally rebalance global trade. I don't care what happens to the S&P. I don't care what happens to the dollar. I don't care what happens to the treasury market. It would have risked a debt spiral because we were already back up at 4% in terms of interest payments as a percent of GDP. That's a 3 sigma move relative to the trailing 25 years. And so if you're talking about, raising the cost of capital across the curve, not just, in equities, but also in the U.S. Treasury market, you're talking about a potential debt spiral in the context of a free-falling dollar. Nobody's going to want to own these securities, and the premium that you're going to have to pay to get capital is going to persistently increase in that kind of scenario. So we think the administration got the memo, and because they got the memo, they have since pivoted us to paradigm C, which is grow your way out of this. Right? Remember we talked about that chart on slide 36, which is, okay, we're going to try to cut our way out of the mess that caused this. And now they're trying to grow their way out of the mess. And so ultimately, as an investor, you got to just start, invest with that as the outcome. Work backwards from there. Ignore the tariff news. I told clients to ignore the congressional brinksmanship news. I'm sure there'll be something else I got to tell them to ignore at some point in the next few months. Ignore the negative news. We're going to wind up with a durable positive shock to growth because there's the only solution that they can, that the administration can drum up to address what I'm showing on the screen here on slide 36.
One more thing before I add back to Justin. I wanted to ask you about AI because I think this plays into it. Obviously, if we're trying to grow our way out, growth from AI would obviously be a very positive thing. But as someone who's not an economist, I don't really understand. Like, I understand AI in my everyday life. I have no idea how it scales up to a global economy. And I'm just wondering, what do you think about AI and its impact and how it potentially relates to this?
Oh, that's an excellent question too, because I think it's like one of these forward turning grenades, I would say just kind of how I'm thinking about AI, and I think investors probably should think about AI. It's like for a while, AI was on this kind of parallel path. But, when you're on a train and they'll click something and like, so now we're no longer on a parallel path. And now AI is going to very much intersect in the real economy at some point. I think it's already doing that in certain sectors and will increasingly do so. And so it's no longer this thing we can sort of talk about it as in the future. It is hitting us right now. I'll throw a statistic out at you. If you look at the unemployment rate for recent grads, I think the New York Fed maintains a statistic. It's all the way up at like 7%. The national unemployment rate is like 4%, 4.1%. The unemployment rate for recent grads, people who would get, commoditized by and replaced by AI more so than most, is 300 basis points north of the nationwide unemployment rate. And by the way, guess what year it broke out above the nationwide unemployment rate for the first time ever in the history of the system? 2022. Do you want to know what happened in 2022? The year ChatGPT came out, for the first time ever, the unemployment rate for recent grads broke out above the nationwide unemployment rate and is now 300 basis points above the nationwide unemployment rate. So AI is already having a significant impact in the economy. We just can't feel it because we all have gray hair. And so the reason I kind of trying to answer this question is, I think AI is going to be one of these things that forces us to rethink how our society and economy are organized. And I'm hopeful that, we get more people from my generation and more people from the generation below us in government so that we make choices that are for the betterment of society and not choices for the worsening of society. And I don't mean that like Gen X and baby boomers are bad people. I just mean that they came up in a culture of winner take all, every man and woman for themselves. And if we try to go down that route, where this is ultimately all going to be headed, and I'll use this chart to explain what I'm trying to say, is labor share of national income, which has been down and to the right for really since the early 90s. But I would say the big assault on labor share of national income kind of came back from 2000. You talk about China joining the WTO, NAFTA in the early 90s, obviously the internet, and globalization all being these big factors that are driving that. And obviously we had to have several tax policy changes, the Bush tax cuts 1 and 2, the Trump tax cuts. We've had these, it's kind of all out assault on the working class individual's ability to generate income in this economy, for a variety of reasons. And one of the key reasons, because greed. We wanted more profits. Wall Street wanted more profits. And so if you look at labor share of national income, we're down at 52% of total. Corporate profits has grown to about 13% of total. If you want to look at where we are in terms of labor share of national income, prior to 2000, we were sort of, 500, we averaged about 500 basis points above where we currently are. And so if you take that 500 basis points, that essentially equates to roughly an annual transfer of about $1.5 trillion from workers to asset owners in the form of, extra corporate profits and higher capitalization of market prices and all that, and so on and so forth. And so that, maybe doesn't sound like a lot in a $30 trillion economy, but what that potentially equates to is a roughly 14% annual loss of income for the median U.S. household. And this is at a time we have a 40-year high in inflation. So think households have been getting pinched both from an income perspective, but also now in recent years from an inflation perspective. And that's why that map looked the way it did on slide 37, one of the many reasons why. And so answering your question on AI, we know that if AI is going to be what it's supposed to be in terms of generating productivity and more profits, that means the blue line has to not only continue to go down, AI is probably going to change the slope and make it even more draconian for society. And so, and make this slope be even more positive for the people who own all the assets in our society. The top quintile of asset owners own 90% of assets in America. So we're essentially we're taking our K-shaped economy and I want to borrow a phrase from my friend Adam Taggart over at Thoughtful Money. He essentially said, hey, AI may accelerate us from a K-shaped economy to a lowercase I-shaped economy, where you have the Mark Zuckerbergs and the Elon Musks of the world have all of the resources, and everyone else, including Darius Dale, Jack Forhead, and Justin Carbonaro. If I'm saying that correctly, I apologize, Justin, if I'm not.
That's okay. Carbonaro, but close enough, man.
Exactly. Where we're down here, looking up at them, and there's no bridge to that. And so that's the outcome that I see from an AI perspective that's likely to happen. That's highly likely to happen if it goes poorly regulated and we just vote the wrong people in office who are, motivated by greed. But if, so this is why I think, part of the fourth turning process, not to get back to that, but part of the fourth turning process is the coming of age of different generational archetypes and essentially wrestling control away from the legacy politicians and legacy institutions so that we can reorganize society in a way that benefits everyone, as opposed to the people at the top of those institutions that are, benefiting the most from an asymmetric standpoint. So hopefully I'm not scaring anybody, but I really want to stress that I'm very bullish structurally, partially as a function of the monetary response you tend to see in fiscal dominance regimes. And this is not just in the US. We have centuries of data from countries all around the world. You tend to see very dovish monetary policy in response to fiscal dominance regimes. So I'm structurally bullish on assets, but I'm also structurally optimistic as in we're going to wind up in a better place, assuming we survive any sort of total war as a country. We're going to wind up in a better place because ultimately, no offense to anybody that's above a certain age, but enough people will die and enough political control will go away from people who are motivated by every man for themselves, greed, more profits, to let's make society better for the common man. And so I'm very optimistic on that. We just have to go through the soup, kind of go down the path of perdition to getting there. And that could be another 5 to 10 years at least.
As we get close to kind of wrapping it up here, I did want to ask you about the KISS model and sort of how that works and how you go about choosing assets because I think that kind of makes everything we've talked about into, like an actionable sort of investment strategy, right?
Yeah, 100%. So I appreciate that. So we talked about Dr. Mo earlier, discretionary risk management overlay. That is our solution for institutional investors, helping institutional investors, stay on the right side of market risk across all the factors, the 70 most important factors that they're, tasked with trading. We take those same exact tools and systems, and we've created what we call our KISS portfolio, KISS model portfolio. And that's a simple and systematic, that's what the two S's stand for, simple and systematic, a solution for retail investors to stay on the right side of market risk without having to do a bunch of work. No offense to us talking right now, listen to a bunch of podcasts, read a bunch of Wall Street Journal articles and Barron's articles all weekend. We're trying to shrink the amount of time and stress that retail investors are allocating to managing their portfolio by keeping them on the right side of market risk with institutional grade risk management. And so that system looks at it takes so it's a competition with the 60/40 portfolio, because that's obviously kind of the line, not the lion's share, but that's kind of the mode of static pie chart asset allocation. That's what many retail investors are being marketed to by Wall Street. And so we say, hey, let's create a solution that's a much better version of that, so that we can create a very short bridge from what they're currently doing to what we think is a much better retirement solution. So it's 60 when the strategy is maxed out as it is currently, it's 60% stocks, it's 30% gold, and it's 10% Bitcoin. Why stocks and gold, or why gold and Bitcoin? Gold and Bitcoin are two assets that are poised to benefit tremendously from a continuation of this fourth turning inspired fiscal dominance regime and the support to the growing geopolitically driven supply and demand imbalance that's a function of that, right? You have Europe remilitarizing, you have China strategically decoupling, and you have Japan normalizing monetary policy after escaping decades of deflation for the last few years. Those are three structural forces that are going to ensure that the marginal demand for U.S. treasuries amongst our foreign creditors, of which they own about a third of all marketable treasury securities, is going to continue to go down. So we need both private investors and the Fed to step up. And so as a function of that, we have this sort of underlying stress in the treasury market that is only going to grow as we go forward in this fiscal dominance regime. And that's going to ultimately require a balance sheet as big and flexible as the Federal Reserve's to fix it and to address it. It's not going to happen overnight, but we've certainly gone in that direction. Since this fourth turning started in the GFC, and obviously, in our view, we're going to accelerate that process in the next 5 to 10 years. And so that's why, instead of having 40% of our portfolios exposed to bonds, why don't we put up 40% of our portfolios in the assets that are actually going to benefit from the fact that the Treasury bond market is a melting ice cube? And so that's how we get to the factor selection. And so just kind of wrapping up in terms of what investors should expect from this type of solution. The average annual return per KISS is 25% on this rolling out of sample back test, which begins in January of 2018. That compares incredibly favorably to an average annual return of only 10% for 60/40. So obviously you can outperform a portfolio that features 40% bonds if you add stocks to gold. That's the easy part. The hard part is beating it from a risk management and volatility perspective, and with KISS trounces 60/40. The max drawdown of our 60/40 or of our KISS portfolio, or KISS model portfolio, is 12%. And there's only double-digit drawdown in the lifetime of this rolling out of sample back test, which begins in January of 2018. The max drawdown for 60/40 is 22%, which has occurred twice in this time frame. And so if you look at KISS relative to 60/40, we have about a 250% upside capture ratio with only about a 50% downside capture ratio. So obviously it's a no-brainer to anybody who's got their portfolio anywhere near 60/40. But where I think KISS really shines, and I know we got to go soon, but where I think KISS really shines is comparing it to a naked long portfolio of the assets that it's actually invested in. And this embellishes the value of the risk management systems that we created here at 42 Macro. KISS relative to a naked long portfolio that is always long 60% stocks, 30% gold, and 10% Bitcoin has a 90% upside capture ratio and a 50% downside capture ratio. So essentially you're getting 90% of the upside, by instituting our risk management pivots in terms of raising cash when it's time to raise cash and redeploying that cash into the same assets when it's time to redeploy that cash. You're getting essentially 90% of the maximum return you could possibly get, but you're getting that with only participating in 50%, roughly 50% of the downside, not even 50% of the downside. And you would have crashed in your portfolio 3 times if you were just naked long 60, 30, 10 stocks, gold, Bitcoin over the past, let's call it 7 years, whereas you wouldn't have crashed once participating in our KISS model portfolio. Again, that minus 12% drawdown in COVID was the only double-digit drawdown in this entire backtest. So this slide is why the success of this system, which has been live since January of 2023. The success of this system is why we're rapidly growing with thousands of clients all around the world, 80 plus countries. And just go to our testimonials page. I could make up the stuff that our clients say about us, because I think we're really doing what we set out to do when we started this company, which is deliver high quality hedge fund solutions to ordinary investors, price points they can actually afford, and with simplicity of the kind of pie chart asset allocation that they're used to. It's not easy to do this stuff, but it's a passion of mine. And so, I feel like I'm really, scratching that itch of giving back in terms of bringing people with me as somebody who's been blessed to get out of a horrible situation.
Mission driven, very passionate about what you're doing and what you're doing for people. So you've given us tons to chew on. This has been great. Thank you very much for taking the time, sharing all this stuff that is usually behind the curtain to your paying subscribers with our audience. And, we hope that people go and check out 42 Macro. So thank you, Darius. We appreciate it.
Yeah, I appreciate you. And if you don't intend to be a client of 42 Macro at any point in the future, totally fine with that, but definitely check us out on Twitter. I'm pretty active on the Twitter. Darius Dale 42 is my handle. I'm pretty active on LinkedIn as well. Darius Dale there. So, we put out a lot of high quality insights outside of our paywall. We just want to make sure that we're helping investors improve not only their investment results, but their investment process as well. That'll be my legacy as it relates to my contributions to our industry. And hopefully we can bring some folks along the ride in terms of helping them grow their portfolios as well. But you obviously got to be behind the paywall for that.
Thanks, Darius.
Appreciate
Thank
you,
you, Darius.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on YouTube or your favorite podcast platform, or leave a review or a comment. We appreciate it.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the participants or their clients.